Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns by keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. On this episode, we're talking Value Investing 101 with the primary focus on how to effectively use the forward price to earnings ratio, or how to navigate valuations like a pro. I want you to be able to avoid value traps and focus on companies that have a higher probability of actually being mispriced. I've been using this method for quite some time, and I've had massive success. I'm not going to delay this episode any further. Let's get straight into it. One of the most common mistakes that investors make is assuming that just because a company has a low price to earnings ratio, that means the stock is cheap. In fact, it's quite common for investors to look at a group of stocks and select the company with the lowest price to earnings ratio because that makes them seem cheaper than all of the others. Allow me to make a distinction, and I want you to verbalize this to yourself so that you can remember this in the future. Price to earnings, price to sales, price to book. These are valuation multiples, not valuations within themselves. A valuation is a technique that looks to estimate the current worth of an asset or a company. So when looking at the forward price to earnings ratio in the correct way, we should say to ourselves, this company is trading at a lower earnings multiple than all of the rest, and understand that there may be a reason for that. So, as a portfolio manager myself, one tactic that I use is the quartile or the quintile approach. This involves sorting companies by their forward price to earnings ratio, then dividing them into 4 or 5 evenly distributed groups. In this particular case, we're going to focus on quartiles or 4 groups. This method is much simpler than it sounds. Here's how it works. Let's just say we wanted to invest in companies from the NASDAQ 100. But we wanted to focus on the companies that may be currently undervalued. First, we sort the companies by their forward price to earnings ratio. Then, we take the bottom half and split that into 2 parts. For the NASDAQ 100, this would leave you with 2 groups of 25 stocks. The trick is that the bottom 25 companies with the lowest price to earnings ratios are not our focus. We focus on the top 25 with slightly higher price to earnings ratios. Remember, there would be 50 other companies in the NASDAQ 100 with higher price to earnings ratios, so these guys are still outside of the more expensive names in the index. What this does is allow you to focus on the more likely undervalued names, while avoiding what may be the most likely to underperform or the names that are cheap for a good reason. This also saves you lots of time. Now, instead of trying to analyze 100 companies to figure out what may be the best price for your portfolio, you get to go straight to the stocks most likely to make great value investments. Research these names and add the most financially strong and well-positioned names to your portfolio. This is one of Wall Street's top strategies for picking undervalued names. When you see that analyst on television saying that they believe a stock is cheap, they likely started here first. The Equity Channel is one of the most followed stock market podcasts for beginners, a valuable resource for investors who are looking for information on the stock market and the economy. We love to make our episodes quick, straight to the point, and rich in value. We hope that's what you got today. Be sure that you subscribe, turn on your notifications, because every time we drop a new episode, money is made.